Hello, my name is Riley Gross, and today I'll be teaching you about CAPM, or Capital Asset Pricing Model. This basically expands off of the risk and return / portfolio theory that we learned about a few weeks ago. And in the situation or the problem today, I will be acting as a VC or venture capital analyst, and I'll be analyzing and calculating 3 different investments and calculating their required returns. So going straight into the problem, I will be looking at the 3 different companies. So first we have Cloud Tech, a software company, and we are given a few different measurements. So first is beta, or the volatility, so how it moves with the market. 1.8 beta is pretty volatile. It is more volatile than the market average, which would be about a 1. The capital structure is 100% equity financed. It's in software, and then it's a high growth startup, so also competing with other SaaS companies. And just knowing the history of companies like this, it is very volatile. Anything in or tech related is always pretty volatile, so that's the reasoning for the high beta. The second company is Regional Bank Corp. So it is a bank, a financial institution, and that is why it is a beta of 1. It's going to, due to it being a financial institution, it is pretty stable, so it's going to move up and down with the market. It almost is equal to the market average, and so it'll move pretty close to it. And then, as you can see, mature and stable, but it doesn't have the highest growths. And then we have an energy company with a beta of 0.5. So this investment isn't going to move up or down too much. It's going to be pretty stable. It's less volatile by a good amount compared to the market, and that's because it's just a utilities company. There's not too much going on. You can predict a lot of what's going on within the company. It's pretty similar year after year. And then we will also be using these parameters for the market. So the risk-free rate, or the hypothetical rate of return, assuming 0 volatility, is 4.5. The market risk premium, or the expected return after the risk rate, or what we would want to get for putting extra risk, is 6%, and then the expected return on the S&P 500 is 10.5, which is just these 2 added up. Additionally, we will be using Gemini to write Python code to give us outputs, and also some different scenarios to look at CAPM, as well as using the driver framework. And I just covered the first stage of the driver framework, which is define and discover. So I explained my the situation at hand, and then I will now be going to represent, which is going to our formula. So the formula for CAPM is, first we're trying to find the required return, or the expected return on the asset. So we're going to take the risk-free rate, which in this case was 4.5%, and then the beta, so that's for the specific company. We're going to do all 3. And then we have right here, which is the market risk premium. Now we're given this in ours, but it is just the expected returns minus our risk-free rate. So going to our collab, we have our code that we got from our Gemini, which we'll pull up right here. So I'm a finance student studying CAPM, looking to explain CAPM if I was a teacher, asked it to give me Python code, and then as well as making sure to comment on the lines, and then I gave it the scenario, and making sure to include formulas. So right here we have the first part, which I just went over the risk-free rate, 4.5%, 0.05 or 45 in decimal form, and then 6% the market risk premium rate. And then here we have the beta, or the volatility, of our 3 investments. And then next we have the equation. So the risk-free rate plus the beta times the market risk premium. Now all of this is just to calculate all of our equations, all of this code here, and then as well as making some plots. So as you can see up here, we imported some packages. We imported NumPy for a little bit of calculations, Matplotlib, Pandas, and Seaborn for more visualizations. So I'm going to run our code real quick. Alright, so this first part right here, we have our the parameters that we were given. We're going to be calculating our required return rate right now. So we have the calculation, which is the risk-free rate of 4.5%, and then this is CloudTech, our software company, so very volatile. Our beta score is 1.8, and then the market risk premium of 6%. So we're going to multiply these two and then add 0.045 to it, and we get 15.3% required return rate. And then for the regional bank, we have a we do the same thing and just plug in its beta score, and we get a 9.9%. And then green energy utilities, we get 7.5%. So something you notice right here is the required return for CloudTech is a lot higher. Now this is because we are taking a lot more risk. So when you put more risk, you like to get more reward. But again, with the volatility, it can go up a lot and you can get high returns, but you can also lose a lot of money due to that volatility. It's pretty unstable, a lot of ups and downs compared to the regional bank, and especially compared to the utilities company. So going back to our driver framework, we just did represent, and now we are implementing, and you can see the output of these calculations in our risk return rate. So we will now be moving on to validate, and we will be looking at some of the graphs that my Python code has generated. Alright, so this graph basically on the y-axis is the required return, and then the volatility or the risk beta score is on the bottom. So right here is our risk-free rate at 4.5%. And then this black dot right here is our market. So we said the S&P 500 expected returns were 10.5%. So that is what that is right here. And then just looking at that, we can see it graphed our required rate of return based on the volatility score right here. So this is CloudTech, this is Regional Bancorp, and then this is Green Energy Utilities. So just kind of visualizing how our required returns are based on the beta score. So you can see that regional is very close and moving much with the market, and then you have CloudTech up here, which high returns but very volatile. Moving on to the evolve stage, I had my Python code generate a heat map to look at the different required rate of returns based on the risk premium as well as the risk-free rate changing, because all of these things are just assumptions. So we can see that the required rate of return can go up to all the way to 18% and as good as 12% based on these changes in the market. Now this map is important because it shows how the required rate of return could swing to 18%, which would be losing us more money. But it can also go to 12%. So this allows us to analyze based on different levels of risk that we would then turn out to the higher ups at the VC firm to make sure that we're analyzing all the possibilities, as well as look into ways to lower our beta score or our volatility, which brings me to my next part of my Python code, which is looking at it, our looking at cloud tech specifically, as it had a high beta score, and in ways that they could reduce this beta score. Now, this beta score for cloud tech is high because in tech companies they're very cyclical, so boom and bust cycles. When they're doing good, they're doing really good. When they're doing bad, they're doing really bad. And this is because new tech, it becomes a wave in consumer culture, as well as bust, for example. Maybe the economy's down as a whole, or another company could have came into the market and they do a product or a service better than this company. So in a way to help stop that and reduce their beta score, they would need to get into maybe more defensive or stable industries of implementation or selling products, and in which they could lower their beta score, which is what they want their target structure to be. Lowering it by 0.4% their beta score, they would be moving still volatile, but their cost of equity would be much lower. So while returns still high, there would be a lot less volatility, and more people would be able to invest in their stock. But not only that, they would also be able to have more profitability on projects, because instead of, whenever there's a boom, hiring a bunch of people, and then whenever there's a bust, firing a bunch of people, they could be more stable in terms of workforce, and can you continue to just strive as much as possible on an inclined slope with a lot less ups and downs, and more of just frequent waves of up and then smaller dips down and then back up again. So that's where lowering the risk would really help cloud tech in this example. Or capital asset pricing model helps you identify the systematic risk within your investments as a company, and it expands off of the risk and return model and allows you to apply it to real world scenarios and to your data, and while still simplistic, allows you to get a better idea of how much you are going to get based on the volatility of an investment, as well as the rates of the market and how it is operating at the moment. Thank you for listening, and I hope you learned more about CAPM.